Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of understanding operating leverage, a key factor in business profitability. Operating leverage is a powerful concept that every business owner should grasp. It refers to how fixed costs affect profitability as sales change. Understanding this can help you make smarter decisions and improve your bottom line. Have you ever wondered why some businesses thrive during economic shifts while others struggle? Operating leverage could be the answer. This video will break down the importance of operating leverage and how it influences your business decisions. By the end, you'll see how to assess your own company's leverage and adjust your strategies accordingly. Let's get started on turning insights into action for better profitability. What is operating leverage? Understanding operating leverage helps you see how fixed and variable costs interplay in your business. It's not just about numbers, it's about making informed decisions that can lead to greater profits. Let's break it down. Definition and explanation. Operating leverage measures how sensitive a company's profit is to changes in sales volume. It emphasizes the fixed costs involved in running a business. Simply put, when sales increase, companies with high operating leverage can expect a larger boost in profits due to their fixed costs remaining constant. Here's how it works. Fixed costs. These costs do not change with sales volume. Think rent, salaries, or equipment leases. High fixed costs mean your profits can really soar when sales rise, but they can also hurt you when sales fall. Variable costs. These expenses change directly with production levels. For example, raw materials and direct labor costs increase as you produce more. To calculate operating leverage, you can use the formula: operating leverage equals contribution margin, net income. In this formula, the contribution margin is the sales revenue minus variable costs, while net income reflects the profit after all expenses. A higher ratio indicates greater sensitivity to sales fluctuations. Importance in business. Understanding operating leverage is crucial for managers for several reasons. Profitability insights. Knowing your operating leverage helps you predict how changes in sales impact profits. If you expect sales to rise, a high operating leverage can signal larger potential gains. Risk management. It's also a double-edged sword. High operating leverage means risk is elevated during downturns. If sales dip significantly, profits could take a hit. Managers should assess their leverage when making financial forecasts. Decision making. Operating leverage plays a role in pricing strategies, budgeting, and investment decisions. It provides guidance when deciding whether to invest in fixed assets, which can raise that leverage. Performance evaluation. By tracking operating leverage over time, businesses can evaluate their cost structure and operational efficiency. This insight allows for adjustments that can lead to improved performance. Recognizing how operating leverage affects your business helps you prepare for what lies ahead. It gives you the tools to strategize effectively, whether you're aiming for growth or trying to safeguard against downturns. How operating leverage works. Operating leverage is essential for understanding how your business can maximize profits. It hinges on the balance between fixed and variable costs and helps gauge how profit changes with sales fluctuations. Let's examine the core components of operating leverage. Fixed versus variable costs. Understanding the difference between fixed and variable costs is fundamental to grasping operating leverage. Fixed costs. These expenses remain constant regardless of production levels. Examples include rent, salaries, and insurance. These costs must be paid whether you sell 1 unit or 1,000. High fixed costs can lead to greater profit margins when sales rise, but they can amplify losses if sales drop. Variable costs. These costs change directly with production levels. They include items like raw materials and hourly labor. When production increases, variable costs rise. Conversely, if production decreases, these costs will drop. Businesses strive to manage these costs to maintain profitability. Both types of costs play a critical role in determining your operating leverage. A higher ratio of fixed costs typically indicates a greater potential for profit when sales increase. However, this also means the risk is higher during downturns. Contribution margin. The contribution margin is a key concept that ties into operating leverage. It reflects how much revenue contributes to covering your fixed costs. To calculate the contribution margin, subtract variable costs from sales revenue. Contribution margin equals sales revenue variable costs. A higher contribution margin means more of each sale contributes to covering fixed costs, leading to larger profits when sales increase. Understanding your contribution margin helps in assessing your operating leverage. For example, if your business sells a product for $100 and incurs $40 in variable costs, your contribution margin is $60. This means that for every unit sold, $60 goes toward covering fixed costs and generating profit. Calculating operating leverage. To understand the impact of operating leverage on profits, you can calculate it using the following formula. Operating leverage equals contribution margin, net income. Where contribution margin, as explained, it's the revenue remaining after variable costs. Net income. This is your profit after all expenses are accounted for. For example, let's say your contribution margin is $200 and your net income is $50. Operating leverage equals $200 per $50 equals 4. This means your profits will rise by 4 times for each percentage increase in sales. Keep in mind that while high operating leverage offers the potential for increased profits, it also poses risks. If sales decline, the impact on net income will be magnified as well. Understanding these calculations allows you to make informed decisions. High operating leverage can signal that you should focus on increasing sales, but also be cautious about managing fixed costs effectively. Recognizing how to measure and interpret operating leverage empowers you to optimize your business strategy and prepare for various market conditions. Types of operating leverage. Understanding the types of operating leverage is essential for navigating a business's financial landscape. Each type can influence decisions, risks, and profitability. Let's explore the characteristics and implications of high and low operating leverage. High operating leverage. Characteristics of businesses with high operating leverage and potential risks. Businesses with high operating leverage typically have a significant amount of fixed costs relative to variable costs. This structure allows them to enjoy greater profit spikes when sales increase. Here are some defining traits and potential pitfalls. High fixed costs. These businesses often invest heavily in factories, equipment, or long-term leases. Think of airlines or manufacturing companies that commit to substantial overheads. Increased profitability with sales growth. When sales rise, the same fixed costs are spread over more units sold. This can lead to impressive profit margins as operating costs remain constant. Magnitude of risk during downturns. While high operating leverage can lead to larger profits, it comes with higher risks. If sales drop, those fixed costs don't vanish. This can result in significant losses. Industry sensitivity. Sectors like travel, entertainment, and manufacturing often face volatile demand. These industries can experience sharp profit declines during economic downturns. Understanding these characteristics allows businesses to make informed projections. Knowing when to scale up operations or cut costs is crucial in managing high operating leverage effectively. Low operating leverage. Characteristics of businesses with low operating leverage and benefits. Low operating leverage is found in businesses where variable costs dominate the cost structure. This model provides more flexibility and less risk. Here are key traits and benefits. Variable cost focus. These businesses rely mainly on direct costs, like retail or service industries. They can quickly adapt to changing demand without being locked into high fixed expenses. Stability during downturns. When sales fluctuate, lower fixed costs mean less drastic impacts on profits. This creates a safer cushion during economic shifts. Easier adjustments. With fewer fixed expenses, companies can easily scale operations up or down. This ability to pivot quickly can be a significant advantage in uncertain markets. Typical industries. Freelancers, consultants, and many service-based firms fit this model. They can adjust their workload and expenses based on client demands without heavy financial burdens. Recognizing the benefits of low operating leverage can help businesses prioritize flexibility and responsiveness. Understanding these characteristics can guide strategic decisions, ensuring stability and adaptability in a changing market. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.